Welcome to Charged Alpha. I'm Hudson, joined by Lana. Today's chapter, Diamondback Energy, the pure-play Permian Basin oil producer that became one of America's most efficient energy machines.
Diamondback was founded in 2007 in Midland, Texas, and went public on NASDAQ in 2012. The strategy from day one: concentrate entirely in the Permian Basin and out-execute through cost discipline.
Operating in a single basin with dense infrastructure and a repeat drilling playbook drove cost per barrel below most North American peers. There was no diversification, just execution.
The defining move came in 2024, the acquisition of Endeavor Energy Resources for roughly $26 billion, doubling the Midland Basin position and pushing production past 460,000 barrels per day.
Matthew Case Van't Hoff became CEO in January 2024, succeeding Travis Stice. At Diamondback since 2016, CFO, then president, he carries one of the deepest operational foundations in Permian E&P.
Trailing 12-month revenue reached $15.2 billion. Q1 2026 came in at $4.2 billion, up 5%. GAAP earnings were minimal, distorted by heavy depreciation from the Endeavor deal.
The real number is free cash flow. In Q1 2026 alone, Diamondback generated $895 million and returned nearly all of it through dividends and buybacks.
Gross margin runs at 60%. The balance sheet carries minimal net debt and $176 million in cash. Capital return is among the most aggressive programs in S&P 500 Energy.
On the radar, Diamondback leads on Permian scale, cost per barrel, and cash return. Devon, EOG, and ConocoPhillips are the closest peers, each formidable but less concentrated in execution.
The reserve inventory is the long-term thesis. Diamondback holds 15-plus years of drilling locations across 780,000 net acres. That runway is the franchise value.
The key risk is WTI oil price. At $70 per barrel, the model generates substantial free cash. Drop to $55 and the return program shrinks.
The Endeavor integration is the near-term execution test. Absorbing a $26 billion acquisition while holding cost discipline is the challenge Van't Hoff inherited with the CEO title.
Diamondback also owns midstream assets and benefits from Permian takeaway additions that have reduced crude quality discounts that once penalized Midland Basin producers.
The dividend structure reflects that confidence. Diamondback pays a base and variable dividend tied to free cash flow, a formula that scales with results.
The price arc, $45 in 2020, a peak of $155 in 2022, and $215 today on growing scale and free cash generation.
Van't Hoff is a financial engineer turned operator, a CFO background that shows in allocation discipline. Diamondback prioritizes per-share value over growth for its own sake.
The investor debate is straightforward. Is the Permian premium, at $38 billion in market cap, justified if oil prices moderate from current levels?
With a 15-year drilling runway and a return program designed to distribute nearly all free cash, the answer depends almost entirely on where WTI oil settles.
That's the company chapter for Diamondback Energy. Permian pure, low cost, and engineered to return cash through any commodity cycle. This is Charged Alpha.
Diamondback drills in the most productive oil basin on Earth and returns nearly every free cash dollar to shareholders. Let's see if the Permian math still works.
Diamondback Energy just delivered Q1 2026 revenue of $4.24 billion, up 5.2% year over year, the only major E&P growing YOY right now. GAAP EPS was 8 cents, which looks ugly, but adjusted EPS came in at $3.85, a 10% beat over the $3.50 estimate. The real story is EBITDA of $1.41 billion and $895 million in free cash flow from a single quarter. This is Charged Alpha.
Diamondback Energy is one of the largest independent oil and gas producers in the Permian Basin. Headquartered in Midland, Texas, the company controls over 780,000 net acres in the Permian, one of the most prolific and lowest-cost oil basins in the world. They produce over 460,000 barrels of oil equivalent per day, and their acreage carries more than 15 years of identified drilling inventory.
In December 2024, Diamondback closed its acquisition of Endeavor Energy Resources for roughly $26 billion, one of the largest private oil company deals ever. That deal doubled their Midland Basin position and transformed FANG into a scale operator. At $37.9 billion in market cap, the stock trades at a 6.5 times EV to EBITDA multiple with a 4.2% dividend yield.
Let's start with what matters most. GAAP EPS of 8 cents is misleading, and we need to be direct about that. Diamondback is running a $26 billion acquisition through its income statement. The depreciation and amortization drag from Endeavor is enormous. That D&A hit has nothing to do with cash generation. The actual cash engine runs at a 33.2% EBITDA margin, $1.41 billion in Q1 alone.
Now the headline numbers. Q1 revenue, $4.24 billion, up 5.2% year over year and up 25.6% quarter over quarter. Compare that to Q4 2025 at $3.38 billion and Q1 2025 at $4.03 billion. This company is the only major E&P posting positive year-over-year growth, while peers like Devon, EOG, and ConocoPhillips all print negative YOY numbers.
Adjusted EPS 385 beat the 350 estimate by exactly 10%. Free cash flow of $895 million in a single quarter, a 21.1% FCF margin on quarterly revenue. That is exceptional capital efficiency. Gross margin came in at 60%. Cash on hand is $176 million, with total debt around $8.5 billion from the Endeavor deal.
The Endeavor acquisition debt is the number bears focus on. $8.5 billion is significant. But run the math. $895 million in quarterly free cash flow annualizes to roughly $3.6 billion. At that pace, FANG can delever materially within 2 to 3 years without impeding capital return. The debt is a feature of the acquisition, not a structural problem with the business.
Production hit 460,000 plus BOE per day. EV to EBITDA at 6.5 times is cheap for an energy company generating this level of cash. For context, that multiple implies the market is paying for less than 7 years of current EBITDA to own 15 plus years of drilling inventory in one of the world's best oil basins.
Capital return. FANG pays a 4.2% dividend yield, well above the S&P 500 average. The company also runs an active buyback program. With the Endeavor integration now closed and synergies flowing through, management has signaled a commitment to returning excess FCF to shareholders as leverage normalizes.
Analyst consensus is firmly bullish. Buy ratings dominate, with an average price target around $260 against a current price near $214, implying roughly 21% upside. That kind of consensus bullishness, combined with below-target pricing, is rare and typically resolves higher as institutional reweighting occurs.
The Street's core thesis is straightforward. FANG is the highest quality, lowest cost Permian operator at the cheapest valuation in the E&P group. 6.5 times EV to EBITDA is inexpensive even in a flat oil price environment. If WTI holds in the high 60s or better, the free cash flow yield is exceptional, and the 21% upside to analyst target is conservative relative to the cash engine underneath.
Analysts who are cautious focus on two things: oil price sensitivity and the GAAP EPS confusion. The 8-cent GAAP number creates noise in quantitative screens and index-based funds that wait on earnings. Some systematic strategies actually have FANG penalized by the D&A-driven GAAP loss optics, which is why the stock may be trading below what cash flow-based models would suggest.
The Endeavor acquisition is a dividing line among analysts. Bears see $8.5 billion in debt on a commodity-exposed balance sheet. Bulls see $3.6 billion in annualized FCF with a proven asset base that produces at industry-leading per-barrel costs. Multiple analysts raise targets post-earnings on the EBITDA margin beat and buyback acceleration.
One nuance the Street is watching: WTI oil price trajectory. FANG's revenue, FCF, and dividend sustainability are all directly tied to commodity prices. If oil slides towards $60, FANG's FCF compresses and the bullish case weakens. If oil holds above 70, the thesis accelerates. That binary commodity exposure is priced into the below peers multiple.
The bull case starts with uniqueness. In a sector where every major peer is shrinking year over year, FANG is the only E&P growing. Devon negative 7.4%, EOG negative 1.6%, ConocoPhillips negative 4.2, FANG positive 5.2. That growth differential in a flat demand energy environment reflects superior acreage, better well economics, and the Endeavor integration delivering scale.
Permian cost discipline is the moat. FANG's Midland Basin wells are among the most economical in the U.S. Low break-evens, high initial production rates, dense spacing across a decade plus of identified locations. Endeavor's acreage is directly adjacent and similarly high quality. The combined footprint has no meaningful degradation in well economics as the rig count scales.
4.2% dividend yield plus buybacks at 6.5 times EV to EBITDA creates a compelling total return package. $895 million in quarterly FCF funds both the dividend and accelerated deleveraging simultaneously. As Endeavor synergies compound and debt comes down, the quality of the balance sheet improves quarter by quarter, a flywheel that benefits both equity and credit investors.
The bear case is real and starts with the $8.5 billion in debt. Diamondback issued that debt to fund Endeavor at a moment when oil prices were higher. If WTI drops towards $60 and stays there, FCF compresses, debt service becomes more onerous, and the buyback program is the first thing to get scaled back. Commodity-funded debt is always a risk in a cyclical business.
100% WTI oil price sensitivity is the structural bear argument. Unlike integrated majors with downstream refining businesses or diversified E&Ps with natural gas hedges, FANG is a pure-play Permian crude oil producer. Geopolitical events, OPEC plus supply decisions, demand softness from China, any of those can move oil 20% in either direction within months.
The GAAP EPS problem is more than cosmetic. Retail investors and quantitative screens read 8 cents and see a company barely breaking even. That perception gap keeps certain institutional mandates away: insurance portfolios, dividend growth screens, some ESG filters. The DNA drag from Endeavor lasts years. The gap confusion is a persistent overhang.
Finally, Permian Basin execution risk. FANG is integrating a $26 billion acquisition while running one of the largest drilling programs in U.S. onshore energy. Any operational disruption, completion crew delays, water disposal constraints, midstream bottlenecks, hits production volumes and FCF simultaneously. Execution complexity at this scale is inherently higher.
The peer comparison tells the FANG story cleanly. Devon Energy, negative 7.4% revenue growth, price to sales 1.0 times. EOG Resources, negative 1.6% growth, 2.7 times PS. ConocoPhillips, negative 4.2% growth, 2.1 times PS. All three peers are shrinking year over year and trading at higher price-to-sales multiples than FANG.
FANG at roughly 0.9 times price to sales is the cheapest stock in its peer group and the only one growing. That combination, lowest valuation, highest growth rate, would typically command a premium. The discount exists because of the debt load and gap confusion. As leverage normalizes over the next 2 years, that gap should compress toward peer multiples.
On EV to EBITDA, FANG at 6.5 times is below the peer group average. Devon trades around 5 to 6 times, but with lower FCF quality given declining production. EOG is more expensive given premium growth positioning. COP runs near 7 times with a higher balance sheet quality premium. FANG sits in a sweet spot: better growth than COP, cheaper valuation, and better FCF than Devon.
The peer conclusion? If you want E&P exposure in Q1 2026, FANG is the only name posting positive growth with a cheap multiple and a generous dividend yield. The Permian Basin concentration is the right bet if you believe U.S. oil production growth continues, and FANG is the most efficient operator in that basin by most cost metrics.
Options activity around the Q1 print was moderate with a put-call ratio of approximately 0.80, neutral positioning. The options market was not strongly directional ahead of earnings, which suggests institutional holders were neither aggressively hedging nor expressing conviction through calls. Oil macro dominates FANG's options market more than any single earnings print.
Post-earnings call positioning targeted the 220 to 230 strike range for July, traders betting on the 21% analyst upside materializing into summer if oil cooperates. Put activity clustered near $200. Protection buyers worried about oil softness, pulling FANG back below the round number. The option structure reflects the commodity binary that defines this stock.
CEO Travis Van Hoff holds a meaningful equity position in Diamondback. No unusual insider selling clusters have appeared around the earnings print. Insiders at energy companies typically transact through pre-scheduled 10b5-1 plans, and FANG executives are no exception. The absence of selling around the print, when the adjusted EPS beat was the clearest positive data point in months, is a constructive signal.
Dividend distributions are ongoing and consistent. The 4.2% yield at current prices means FANG shareholders are being paid to wait for commodity prices to cooperate and analyst target gaps to close. With quarterly FCF covering the dividend approximately 4 times over, the dividend is structurally safe, even if oil softens moderately from current levels. The payout is not at risk.
Bottom line, Diamondback delivered Q1 2026 with $1.41 billion EBITDA, $895 million in FCF, and a 10% adjusted EPS beat. Gap is noise. This is the only E&P growing year over year. 6.5 times EV to EBITDA with a 4.2% yield is cheap.
Debt and oil sensitivity are the real risks. Watch WTI and quarterly FCF. As leverage compresses, FANG should converge toward peer multiples, and that math points to 260. Diamondback Energy Q1 2026 on Charged Alpha.
Financial data and charts sourced from Financial Modeling Prep. Charged Alpha is for informational and educational purposes only. This is not investment advice. Always do your own research before making investment decisions. Thanks for listening to Charged Alpha. Subscribe and leave a review if this was useful. New episodes every earnings season. See you on the next one.
Ooh-wee-doo! That ticker tape starts dancing fast. A bull market thrill that's built to last. Dividends are ringing up the swing. Listen to that sweet ka-ching. It's a Wall Street swing. That fast-paced rhythm makes you sing. Yeah, the Wall Street swing.